Hey everyone, what's up and welcome to Front Run, where we predict the future of money and technology. I'm your host, John Cook. Today is Thursday, February 23rd, 2023, and today on Front Run Out Loud, we are going to recap the latest news events and like the really big ticket items that are making the headlines today in the crypto Ethereum ecosystem, as well as some of the items that are not making the mainstream headlines but should be. Today, we're going to cover the Optimism Coinbase deploying its base platform on Optimism Layer 2, corresponding analytics around that. Go into some tokenomics and this code is law construct with dydx. And this happened a while ago, but I got to call it out. Then we'll wrap it up with, I think, what is the next phase of the ICO bull run we experienced in 2017, 2018, also happening on Arbitrum. And then we'll close it out with some economic data and the implication related to crypto. So let's dive into it. This morning, for those who don't follow on crypto Twitter, there was this trending theme yesterday related to like a blue logo and some unveiling that Coinbase was going to do today, Thursday. Well, it turns out that Coinbase announced, and I have this pulled up to the screen for those watching in YouTube land, this new program called Build on Base. Build on Base is a layer 2 Ethereum. Uh, it's a layer 2 protocol that you can build DeFi apps on. Like, that's the punchline. What's cool about it, though, is the layer 2 protocol technology being used is Optimism. So you can imagine of like the big players in the L2 wars, whether it's, well, Polygon's technically a side chain, but it will be an L2 soon with ZK Sync. Of course, Optimism, of course, Arbitrum, there's Boba Networks, there's some other ones as well. This is not only a huge win for Optimism, but I think it's a huge win for crypto in general. Why? Coinbase is the de facto on-ramp for crypto users in the United States. Sure, there's Kraken and some other platforms, but Coinbase is the only crypto exchange that's regulated by the SEC, publicly traded. And as a byproduct of that regulation, it has very limited ability to deploy the same types of features and functions that you'd see on like an unregulated crypto exchange or perhaps an exchange that's headquarters like offshore. For example, Binance is a really obvious example, or even KuCoin that offers like derivative leverage trades. You see, Coinbase can't do that, and it's very intentional. Coinbase is regulated by the SEC, and that's not something you can do on Coinbase because Coinbase has took the stance that crypto is not a security, and leverage trading is something you do with securities. With that said, Coinbase is now building this layer 2 protocol using Optimism technology. And why this matters is it's completely decentralized in that it's not controlled by a central entity the way the Coinbase centralized exchange is. So Coinbase is going to deploy this L2 using Optimism as the underlying technology. And then once the L2 is deployed, people are going to be able to build DeFi apps on the Coinbase L2 called Base. And it's pretty sick because I think I saw Euler Labs make an announcement. Let me pull it up really quick. That they're deploying. Yeah, this is wild, man. So Euler Labs, Euler is a decentralized protocol to facilitate borrow lending. They announced also today that we're excited to support Build on Base, Coinbase's new created layer 2 scaling solution. Through Aave and Euler Finance, we're ready to bring Balancer boosted pool technology to Base. So that is pretty sick. And you can see Michael Bentley, the CEO of Euler Finance, also tweets, we're delighted to reveal that Euler Labs is building on Base testnet. Coinbase millions of users are about to be introduced to a future which is open, on-chain, and non-custodial. That's the game changer here. Non-custodial platforms that let individual users take control of their crypto by owning their private keys. With great uh, with great power comes great responsibility for sure. But I'm super bullish on crypto in general because Coinbase is now providing the ecosystem that lets individuals on ramp into fiat, on ramp their fiat into crypto using SEC regulated approved Coinbase.com. And then once you're ready to take control of your private keys and you want to experience some of the perhaps more bespoke degen opportunities that exist on crypto, specifically Ethereum, you can now do so using the base layer 2 protocol that's being built using Optimism's technology. And this is also super bullish for Optimism. The Optimism OP token. Let me pull up TradingView really quick to see the impact on the buy sell pressure for the OP token. And it probably went up. Yeah, when Coinbase did the announcement today, we can see that the OP token popped like 305, then it's now down to 280. I think I wrote an article about this on farmcrypto.com. The way the Optimism token works, and I'm going to switch to the next topic, is it's a layer 2 protocol, right? So it collects fees from people transacting on OP, right? Every time you transact on OP, you have to pay a fee, which is like the gas, the GUI, right? And then that goes to the Optimism protocol, pretty much as follows. And this is going to go into the profitability of Optimism, which goes into like potentially the valuation of the OP token. So I've pulled up a tweet from Token Terminal that outlines the Optimism L2 financial statement. Now they've made some like points related to the PS ratio, PF ratio. We can get into that in a little bit, but what I want to call out, let's see if I can go there directly. This is super small. Yeah, this might be easier. Token Terminal. Yeah, because I see this. Then I'm going to go to financial statements, and I think I should see Optimism. Yeah, cool. Here it is. So let's focus on the weekly view. It's easy to digest. So like, okay, how does Optimism? Why is the Optimism worth the price it's worth? Why is it not worth $20 or $5 or $1? Right. So the way Optimism works, the profitability of Optimism is a byproduct of its revenue, of its fee collection capabilities. And what that means in plain English is when you transact on Optimism, whether by interacting with a smart contract or even just sending ETH from one person to another, you pay a fee for that. That fee is measured in GUI, and it's called gas, right? So this is saying on week 8 of 2023, this is week starting February 19th, the fees that Optimism collected were approximately 276,000 USD. Okay, so now that's how much the protocol collected in transaction fees, right? Now, what happens with that money? So since Optimism is a layer 2, it has to pay for security, right? And the security is paid for via the Ethereum base layer. So this is quantified as supply side fees that the Optimism L2 protocol pays to base layer Ethereum L1 in exchange for security. Like the way Optimism works at a very macro level is that transactions are bundled together, sent at the L2 layer, sent down to the Ethereum base layer, and then that is what's propagated to the nodes, added to the blockchain, etc. And in exchange for that, Optimism L2 pays for the security of the Ethereum base layer. Week 8, 2023, Optimism paid around $237,000 from the $275,000, right? That was collected. Now, That leaves $38,000. Okay, so 275 minus 237 is about $38,000. Great. You can say the Optimism protocol is profitable. It is profitable now, but it wasn't recently because there's other factors you have to consider, like token incentives. So token incentives are a marketing expense that protocols like Optimism use to incentivize people to use the platform. Very simple example is when the OP is when Optimism first rolled out, they had the incentive program on Aave where individuals could deploy ETH to the Aave lending pool and earn yield on it. In addition to the yield earned on ETH, like they would earn like 1, 2, 3% in OP tokens, right? That's a token incentive. So you can see if you look at week 8, 2023, Optimism collected $275,000, paid $237,000 out as security fees to the Ethereum base layer. That leaves $38,000, and then in addition to that, there's a lot of debate on this. Optimism paid approximately $2,000 out, $2,000 worth of OP tokens out as an incentive. So one point of view on this is that, well, this is an expense because it's a fee. It's an expense in that it goes from the Optimism treasury and it's paid out to users as an incentive for the platform. Another point of view is that no matter how many tokens you create, all you're diluting is like the per token value, but at the end of the day, you're still going to have the same Optimism market cap. So if there's a billion Optimism tokens and the market cap's 3 billion, and then you create a million Optimism tokens, the market cap's still going to be 3 billion, but now the price per token is going to go down. So in that scenario, some people don't consider it a token incentive. Either way, I'm of the mindset that paying for utilization on the OP protocol or any protocol in general is an expense that should be accounted for. So when you back out the token incentives, you're left with net earnings of $35,000 USD, right? You can compare that to week 7, where I mean, it's crazy. The token incentives was so gnarly, right? You can see that I almost got to double check it. This is crazy. Week 7, they paid out $15 million in OP tokens. Week 6, they paid out $34 million in OP tokens, right? I wonder what this token incentive is from. This is a very high number. Maybe if we span out to like, let's see what the quarterly view is. Yeah. So week over week, with respect to like just the initial like launch of base on OP, for sure it's driving utilization, but in the aggregate Q1 2023, Q4 2022, you can see beyond a doubt, it's undeniable that the token incentives that Optimism pays out to its users for using the Optimism protocol is much greater than the revenue collected after accounting for supply side. Hell, even accounting before supply. No, let's keep it real. Yeah, Q4 2022 collected $4 million in revenue in fees, paid out $3 million in security to Ethereum base 1. That left 800 Ethereum layer 1. That left 884,000. Paid out 26 million in token incentives. That left OP with a net earnings of negative 25 million. Now you could do all sorts of things with this, like extrapolate like with the PF ratio. For some reason, Token Terminal doesn't have the PE ratio. I don't know why they don't, because like at the end of the day, when you buy a token, you're paying for its future earnings, right? So at a price point of 282, the way it works in TradFi is that you're paying $2.82 for every dollar of earnings. But the challenge here is that your OP is not profitable, so you're actually paying $2.82. PE ratio would actually not be an option because there's no earnings. So This is why they use like the PF ratio, PS ratio, but I'd proceed with caution. And if you're going to try to do a valuation on Optimism, I would take into account just the user adoption. This might be a little more quantifiable. Daily active users, maybe developer commits might be, the number of developers could be an interesting opportunity. I would look at revenue growth. Is it growing or decreasing? I would overlay the token incentives, then try to calculate, is this growth organic or really a byproduct of token incentives? And then from there, you could do some like P ratio where you can like flip the PE ratio on its head, back out EPS, and get the share price that way. I posted this on frontruncrypto.com. So either way, whether you agree with the price point of Optimism or not, it's super bullish to see not only Coinbase launch completely non-custodial, decentralized L2 on Ethereum, but they're also using Optimism, and it's generally a bullish proposition for the entire Ethereum ecosystem in general. But what I want to point out is that there is some contention. So when Base was launched, you can see this on Tier 10K, who I follow. Base made a commitment to contribute 20% of sequencer revenue to funding public goods. So this is essentially when we say contributing 20% of sequencer revenue to funding public goods, that means that the revenue that Base collects from transactions, 20% of that is going to be reallocated to Optimism, specifically within their funding public goods program, which is really an entity that identifies compelling and impactful DeFi projects and then grants them and awards them grants. That was the initial angle. But now with the launch of Base on Optimism, Coinbase changed their commitment. It went from 20% of sequencer revenue to, quote, we are contributing a portion of sequencer revenue to funding public goods. So what happened, right? Well, if we scroll down, Jesse Pollock, who's like I think he's like an engineering director at Coinbase, basically said that we are working with the Optimism Collective to ensure that the OP stack has public goods available to everyone, including a contribution of sequencer revenue to funding, right? So, oops, they backed out. I don't think this caught the mainstream crypto Twitter headlines today, but it just goes to show, man, that this whole angle of code is law. I don't think code is law, and we're going to talk about this a little bit later. I'm super optimistic for crypto and DeFi and Ethereum that we're seeing this base layer 2 built, but stuff like this, like like Coinbase changing their commitment to sequencer revenue allocation to funding public goods is not a good look, and it leads into like my next point is that there's this general theme within the Ethereum ecosystem where code is law, and essentially the angle with code is law is that rather than a program or a protocol being managed by an organization of fallible humans who are subject to greed, anger, resentment, fear, love, hatred, all these emotions that might cause them to make questionable decisions related to the protocol, if you put the rules of the protocol, whether it's the vesting schedule or the revenue allocation, into the code becomes the law, such that you don't have to worry about like humans changing the rules. Well, what happens is humans just change the code, and that's changing the rules. Now, granted that the Optimism Coinbase Base L2 project has not been deployed to Optimism yet, so you could make the case to me, John, code is law, but this is still just like a design that's in progress. Sure. But this leads me to like my next point, is that there's just been like this ongoing proliferation of like protocols changing the rules that they've committed to as part of the initial launch. So if you think that Coinbase base layer 2, Coinbase's base L2 that has committed to allocating 20% of its sequencer revenue to Optimism could be a potential violation of the code is law construct. We can see here, this is posted by Spreak Away on crypto Twitter. This is Gelato Network quoting a snapshot vote to accelerate the vesting of private investor tokens passed with 54% of participating voters, accounting for 90% of the voting power, voting in favor of the proposal. As a result, the unlocking of private investor tokens will happen on Monday, the 27th of February, which will increase the total circulating supply of GEL tokens by 44 million. Okay, so there is a vesting smart contract, and the vesting smart contract says you're going to receive your token allocation 1/48 in equal distributions every month for the next 48 months. What's happening here is that the Gelato Network just voted to change the vesting schedule. Is that not code is law violation? So instead of this 1/48th token distribution, which is in the vesting smart contract, they just passed a snapshot vote to change the vesting smart contract such that all the tokens are going to be unlocked and distributed to the owners in the early investors. What do you think is going to happen to this? I'm reasonably convinced there's going to be a dump on retail traders. So like this is happening on the 27th of February. That's not this week. So let me look at see if I can gel USDT. See this, yeah. Yeah, and you can see, look, there was a pump and then a dump. This is very disappointing because what piqued my interest in this entire discussion, and full disclosure, I'm an advisor at a startup that is building a token management platform that enables VC funds to manage their token allocation and investing schedules. But you can see that dydx Foundation, this actually came out 2 weeks ago, and it went completely under the radar. Like, it didn't get any headlines at all on crypto Twitter. And the TLDR is that dydx Trading, which is like a derivatives trading platform that was on Ethereum, and then I think they migrated to Cosmos. They changed the token lockup schedule for dydx token holders. They basically extended the unlock schedule. So they took the opposite route of the gel token holders. And I'm reading the thread from dydx Foundation. Let's read it out loud together. On August 3rd, 2021, dydx Foundation issued dydx, a governance token that aligns incentives between traders, liquidity providers, and partners. That's not a hot take, right? The initial allocation of the dydx token included like investors, founders, and future employees, consultants of dydx, right? So the initial vesting smart contract. Let's see what the warrant amendment mentioned above does not alter the staggered unlock that occurs after the initial unlock date, and therefore the investor dydx tokens will be released from the transfer restrictions as follows, right? They're going to have a new unlock date on December 1st, 2023, followed by 3 additional unlock dates on January 1st, 2024, another tranche in 2025, and another tranche in 2026. So somebody on crypto Twitter replied, and with the correct response, never seen something like this before. How is this even possible? SAF contracts have been signed and now rules are being changed. I guess there is a first step for everything. This is nonsense. And it is nonsense because what is happening right now is dydx is changing the vesting schedule of the dydx token holders. And the way this works is if you invest in like a crypto token like dydx, what you receive, what you're committing to is something called the SAP. It's a simple agreement for future tokens. It says It's a piece of paper that says, I'm going to give this protocol $1 million. In exchange for that, they're going to grant me 10 million dydx tokens, as an example, that will be vested and available for unlock after a 12-month vesting cliff at a rate of 1/148th allocation for the remaining 36 months, right? So that means at month 12, you're going to get 12 of the 48. You're going to get 12, 26, 48. You're going to get 12 divided by 48% of the tokens. And then at month 13, you're going to get another 1/48th. Then on February, you're going to get 1/48th, March 1/48th, so on and so forth. That's like that's the rules in the vesting smart contract, as well as the rules in the SAFT contract. So now dydx has changed their token distribution, Gel has changed their token distribution, and Coinbase is changing their sequencer revenue contribution on the new base token. So this is all this means is that there's engineers are going into the vesting smart contract and changing the vesting contract. They're changing the code. So if there's a crypto maxi, I'm a crypto maxi, I love Ethereum, tons of potential. But if they go to you and say code is law, I would push back and ask them, how is code law when it's for sure managed by humans and subject to the same greed, hubris, and this range of emotions that TradFi, that also permeate in TradFi? I mean, we got to watch out for this, guys, but I'd be super careful about, I don't think this is a good luck, not only for the OP token, but also for dydx and Gel. So moving on. Next, there's been a lot of news related to just Binance. I wrote a while ago in 2020 through 2022. You can check it out on farmcrypto.com about questioning the solvency of Binance via the BNB token, right? So BNB token, it has like a highly aggregated token holder population amongst its like top 100 tokens. They control top 100 wallets. They control like 70% of the total token allocation. Binance Smart Chain has like 23 node operators. Like the CEO ZZ can just tell the nodes, hey, like roll back this change, and they'll just do it on the fly. And then like sometime last year, Binance changed the default stablecoin from USDC such that all stablecoins that were on-ramped into Binance were automatically converted to be USD, just automatically, and it crushed USD for a minute. And then now, fast forward, what happens? BUSD is getting regulated by the United States government. Paxos, which is like the manager of the BUSD token, is like breaking relationships with Binance. CZ, the Binance CEO, is trying to step away from like this entire relationship, even though it's his protocol that like did the auto conversion from USDC to Binance. And then after that, like USD on ramps were like banned from Binance unless the amounts were like greater than $100,000. This is all like in the past 3 months, by the way. And now, as of this morning, Binance announces immediate closure of Binance Australia derivative positions and accounts, right? Customer service team will contact you as soon as possible. However, you are able to continue to use services offered by Invest by BitPay as normal. This includes buying, selling crypto. If you wish to access the Binance Australia derivatives trading platform, you will need to provide new information and evidence how you meet the requirements to be classified as a wholesale investor, and it goes on and on. So you can see Binance regulatory crackdown, US and beyond. I think I predict worse outcomes for Binance in 2024. I I acknowledge that the BNB token powers the Binance Smart Chain, but I question the equal distribution of the BNB token holders. I question the saliency of the Binance BUSD token. I question whether or not the Binance exchange actually has the tokens in its possession. You can see from like previous interviews with CZ, every time he is asked on the spot, does Binance have its users' assets safely custodied? He responds with some like off the wall statement like, oh, we'll let our lawyers handle that. So I just be incredibly cautious. But as of today, Binance is now closing its Australia derivatives platform, which is exactly what Coinbase doesn't have because it's regulated by the SEC, right? Derivatives trading is like you go long or short on a position, you take leverage on it. Like I think Ethereum's going to go up 20% or maybe 5% in the next 30 minutes. So I'm going to take a 1,000 times leverage position on it. You pay the premium. If you win, you get the upside. If you lose, then you lose your principal, and then the amount goes to the liquidity pool. If it's like a decentralized platform, if it's centralized, then it just goes to like the exchange. So like, if you want to do these derivative trading solutions, you can use like Gains or GMX. Be careful if you're on Binance. I think worse days are ahead. And now that leads us to the next topic, which is, let's see if I can find this. It's GMX. I saw this really, really just powerful tweet published by Token Inside, and it's called the GMX Lego. And man, if you want to know why GMX is trading at like $80 a token, I listened to a recent interview, I think on like Banklist or somewhere, where they interviewed the GMX team, and their position is that GMX is going to be the base layer on which other applications are built. So you might be saying, how is that possible? GMX is already a layer 2 on Arbitrum. Well, there's a ton of like vaults, and they're really like GLP vaults that already exist on top of GMX, as well as like lending vaults. So for example, I pulled up this report called the GMX Lego. If you imagine that GMX is the base layer, what happens is, and full disclosure, I have long positions in Neutro, which is like a GLP vault. So let's say you are earning yield on the GLP token, which is the GLP token is the token in addition to GMX that earns revenue via via trading fees. So like if you go long on a position on ETH and ETH goes sideways or the other way, you lose your principal, and then like a portion of that principal that you paid goes to the GLP token holders, right? So this GLP token is subject to like the ebbs and flows of the market, and it can go up, it can go down. So a lot of vaults have been created where you deploy GLP to the vault, and it tries to run like a delta neutral strategy, which is basically a fancy way of saying whether the price goes up or goes down, the trading strategy of the vault is such that your GLP principal is also protected. So GMX base layer, then vaults are deployed on top of it. Neutra is an example of that. Also, there's like lending platforms like Sentiments, which I'm a big fan of, as well as Tenderfy, Rodeo. Essentially, what happens there is you deploy ETH, and you can take leverage positions on GMX. And then for some platforms like GMX, you can even take that leverage position and turn it into like a GLP opportunity. So like what that means is you deposit 1 ETH, you can take up to like 3 ETH of leverage on like the GMX token or the GLP token, and then you can earn yield by deploying that to like a lending vault. But the challenge is that on these lending platforms, as you know, you're subject to like liquidity loss when your trade goes. You're subject to principal loss when your trade goes sideways. Like for example, or check it out on frontcrypto.com. I If you go like 5x long on Ethereum, and Ethereum loses like 10% of its value, you've lost your principal and you're going to get automatically liquidated. So in that scenario, code is law. So super pumped about GMX. I'm long on it, and this is an example of the power of the crypto tokens that are used to like power GMX. It's not a shitcoin in that revenue from the protocol accrues to the GMX token holders, the GLP token holders, and then from there, you can do stuff with that GMX, like put it into like a lending vault, earn yield on that. You can go leverage long, leverage short using sentiment. And this is going to be the proliferation that I think other derivatives platforms like GNS and Gains are going to follow to like ramp up the price of their crypto token. So check out the GMX logo. And finally, our last note is I am super pumped. I know there are a lot of people who were not a fan of like the ICO bull run in 2017. There's a lot of shitcoins in there for sure, but if you are, you can check out Camelot. It's a community-driven decentralized exchange. I think it's based on Uniswap actually, but it was deployed to Arbitrum, and you can trade like all your popular tokens on there for sure. But what I like about the Camelot exchange is this concept called launchpad. So on launchpad, you can have a fair token launch. So this draws similarities to the ICO boom in 2017, where uh, you want to participate in an ICO offering, you would try to get there early enough, deploy your capital, and hopefully there was still it wasn't so oversubscribed such that you didn't have the opportunity to do so. Launchpad is flipping it on its head and saying, hey, any token that wants to have an ICO event, use Camelot's Launchpad and participate in a fair auction launch. And what that means is that token protocol projects will have like a goal where they'll want to raise $100,000, $1 million, or whatever, or maybe $50,000, and individuals who are supportive of that project or just speculators will deploy USDC or ETH to the project as an ICO, but the price of the token will not be finalized until the total amount has been collected. So let's say that we'll go to an example right now for FCTR Factor. Factor, is this an active token right now? Yeah, there it is. So Factor raised $6,550,000 from a variety of people. I know there's a lot of like speculation on FCTR is like a Ponzi or not, but put that to the side. You have to do due diligence on that. So basically, FCTR, Nutra, and these other platforms say, "Hey, I want to raise money. I'm going to deploy my ICO on Camelot Launchpad via fair auction. People are going to invest USDC ETH into the project, and then when the ICO time runs out, in this case for Camelot, 18 hours, the number of tokens that the price of each token is a reflection of the total amount raised. So that means everyone pays the same price. So you can see the auction will start with a fully diluted value of $10 million with a floor price of 1 cent per token, right? And will increase proportionally after the first million has been raised. Once 1 million has been raised, we'll enter a price discovery phase where the token will continuously increase at every purchase. So that they're basically saying that there's a floor price of 1 cent, but once the so if not enough money is raised, then the minimum price will be 1 cent. But if $1 million, if at least $1 million are raised, the price will be a reflection of the total tokens available divided the amount raised divided by the total tokens available, and then that will determine the token price, and then it will just go up, up, up. So you can see, let's see how this is valued. The tokens you'll receive will have the exact same dollar value as your contribution. Yeah. So they're gonna allocate 10 million tokens to this token launch. They've raised 6.5 million so far. So 6.5 million divided by 10 million is 65 cents, which is the current price per token. Now, if they raise 9 million, then the price would be 90 cents. If they raise $11 million, then the price would be $1.10. So that matters. what I find impactful about this is not so much that it's an auction, but like it's a fair launch auction. So that means whether you invest in hour 1 or hour 36 or hour 100, you're going to pay the same price, which is a byproduct of the total amount raised. So if you want to get involved in some ICOs on Ethereum L2 on Arbitrum, I'd recommend you check out Launchpad. But like, keep in mind, you got to do your research because most of these tokens will have some like lockup period, which is like called an escrow period or something along those lines. GMX has something popular. I threw 200 into NEU just to see how it worked. And the way it works is that you basically buy, you're granted a number of tokens depending on the final share price, token price. In this case, 65 cents. So I was granted approximately 306 NEU tokens, but like it was distributed 50% NEU, 50% escrowed NEU. The escrowed NEU has a 12-month lockup period, which prevents like a pump and dump from the after the initial token launch. So if you think you want to like buy it and sell it like right after the token goes public, you'll be able to do that for some, but for sure not for all. In this case, I sold 150 tokens when the price got to around like $2 or maybe 150, and now it's hovering around 2. We're gonna let it ride until the lockup period ends. So if you want to check it out, I'll put the URL in the show notes for you. And last but not least, we're gonna wrap this up with economic data. Lots of talk around inflation, deflation, recession, strong job market, debt ceiling, war with Russia, war with China, yada, yada, yada. A lot of hot takes on Twitter. I encourage everyone to go directly to the source. And what you'll see is that there are aggregators like econoday.com that actually take the various economic events that happen throughout the day and put it in an economic calendar, which is what you see here. So, for example, today on the 23rd, there was a 3-month Treasury bill settlement, jobless claims reports was released, 3-month bill announcement, and the Fed balance sheet was released, right? And then people take this news, and then like they'll make tweets about it, might write articles about it, But it's all secondhand information. So I'd encourage you to go directly to the source because they just report it as is directly from the government. And again, you can check out econoday.com, or it's also in the show notes. So you can see for econoday.com, we're looking at the Federal Reserve total assets. Like how much you heard the money printer go burr meme. This is it, right? Money printer go burr or not. In a quantitative easing cycle, which you might know as a 0% interest rate environment, the federal government, the Federal Reserve prints money, burr, and that's what like that stimulates investing, and that was really a catalyst for the 2021 bull run we saw across all asset classes. But is the printer still on? The answer is no, but not so much. So the Federal Reserve balance sheet went from something like let me look at Federal Reserve balance sheet, Fred. Let's see what it's at. Total assets less. Yeah, it was pretty gnarly. So the balance sheet went from $4 trillion in like 2020 to like $8.9 trillion at its peak in 2022. That's called quantitative easing. That's when like the where the Federal Reserve buys treasuries from the U.S. Treasury. It becomes a liability. It becomes an asset on the Federal Reserve's balance sheet, and then they got to pay it back though, because now the money's, if you buy $1 trillion in treasuries, it's given to the Treasury, and then the Treasury stimulates the U.S. economy by giving that $1 trillion to governmental agencies who give it to like nonprofits and commercial institutions who go out and do stuff, right? And that's how you stimulate the money printing. But now, with this economic calendar outlook that was published today, it's the updated the Federal Reserve balance sheet, and it shows, quote, Federal Reserve banks show total assets down 2.5 billion to 8.3 trillion from a week ago prior Wednesday, right? This decrease was mainly from a decline in securities held outright of $3.5 billion with an offset of initial increase in $2.1 billion in other assets, right? The securities are the treasury bills, right? And we can go on and say that in 2017, the Fed announced a program of quantitative tightening to reduce its balance sheet through the gradual reduction of both Treasury and mortgage-backed security holdings. Right, that's what happened. But then fast forward to 2019, the Fed announced that it will begin increasing the balance sheet again on October 25th, on October 15th, by buying Treasury bills, right? And that's what cranked it up to like $9 trillion, $8.9 trillion in 2022, right? So now the Federal Reserve is trying to reverse course, and you can see that at the table at the top, the prior period had $8.3 trillion. Sorry, God, these numbers are so large. Like the total assets in possession went down $2.5 billion to $8.382 trillion. And that only impacts the the third decimal to the right of the amount of assets on the federal balance sheet. It's crazy, man. So you can see like this is bad because the amount of assets we have, this is really a reflection of like the economic spending of the Federal Reserve, and you can see that the Federal Reserve's attempt to reduce its balance sheet is a reflection of like quantitative tightening, which is a mechanism to spend less when the government spends less and the Federal Reserve increases interest rates. It makes the cost of borrowing go higher. When the cost of borrowing is higher, companies are less incentivized to take on incremental debt to facilitate these new initiatives, whether it's building roads, planes, bridges, computer software. And because companies are willing to invest in less, they have to be more rigorous with the money they have, which means they cut down on hiring, cut down on spending. When companies cut down on hiring, cut down on spending, it's implied that consumers spend less. When consumers spend less, customers make less, companies make less money, which causes the earnings per share and the PE ratio to go down. When the E goes down in the PE ratio, stocks become more expensive, which causes stock prices to go down. And when that happens, everyone stops spending and inflation goes down, right? That's like the vision of the Federal Reserve, and that's what's happening right now with respect to a reduction in its balance sheet, as well as an increase in corresponding federal funds rate. So that's all I got, guys. If you enjoyed what you heard, hit the subscribe, like button. Follow me on Front Run. Follow me on Twitter at Front Run John, or check out my newsletter at frontrunCrypto.com. It's all free. We'll be back next time for more crypto updates. Remember, do your own research. Check primary sources first. Be incredibly cautious with everything you hear, and continue to be bullish. Alrighty, guys. Peace. See you next time.